Hi everyone, welcome back to the US CPA classes for Financial Accounting and Reporting Examination. In this particular video, I'll be walking you through in detail step 4, that is allocation of transaction price to the performance obligation. This is fifth part of ASC 606 videos, so please watch in a sequence, and in this video we'll be discussing in detail about allocation of transaction price to the performance obligation. So let's dive into to understand more in detail. What are the 5 components of transaction price?
Let's start with fixed price this time.
Yep, you got it.
Fixed price, and then we will adjust variable consideration and constraints. We'll adjust significant financing component. Will like consider the payable to the customers basically. And the last one is non-cash considerations.
Right, perfect. Cool. So shall we jump into the fourth step? Everyone ready to dive in? Fourth step, allocation of transaction price. The small one, quick one. We can finish today. So first step is identification of contract. Second is identification of performance obligation. Third is identification of transaction price. Now it's time to allocate the transaction price to the performance obligation, right? So performance obligation we identify in step 2. So let's continue the same example of sale of car, right? In that, what all performance obligation we have identified? Transfer of car, giving extended warranty, giving insurance, right? So these are the 3 performance obligation. So just keep that example and the numbers in mind, and let's understand how we need to allocate the transaction price. An entity should allocate the transaction price to each material performance obligation. What are the 3 performance obligation? Sale of car,
warranty, and insurance.
Insurance, right? In an amount that depict the amount consideration to which entity expect to be entitled in exchange of satisfying each performance obligation. That means total amount which you are receiving, against which what all performance obligation you have, and to those respective performance obligation what amount should be allocated to the respective performance obligation and need to be considered upon satisfaction of those performance obligation. So first thing is stand-alone selling price. Stand-alone selling price is independent selling price. Like in our example, we discussed $100,000 for the car, $10,000 for the extended warranty, $5,000 for the insurance. Right? Those independent price for the independent product and services are called stand-alone selling price. So standalone selling price, in short we call SSP, is the price at which the entity would sell the promised goods or services separately to the customer. It should be used to allocate the transaction price to each of those performance obligations. So this is considered as a base for allocation of the transaction price to the respective performance obligation. How do you identify the transaction price? How do you identify the standalone selling price, right? So there are certain methods for identification of standalone selling price. There might be possibility in some of the scenario it is not very much clear that what should be the standalone selling price of the respective product or services. For example, let's say your company required a trainer for the US GAAP, right? And then you have started hunting the US GAAP trainer and you come across with 3 or 4 trainer, right? So one trainer is charging $50 an hour, another might be charging $70, another might be charging $100, and another might be charging $200, right? So, but how do you identify what will be the price for those kind of training, right? Or if I give like another example, let's assume you fly, you are like an airline like in airline industry, let's say you are United Airlines or you are Delta Airlines or you are, any other airlines, Frontier Airlines. So there are like so many airlines in US, right? And you wanted to fix the price for like flight from San Francisco to, let's say, Los Angeles, right? How do you fix the price? How do you identify the price? And what do you feel should be the right price of your flight from San Francisco to Los Angeles? Hmm? So there are certain methods which are being defined in the standard. One is observable price method, and second is acceptable estimation method. Hmm? So first preference is always an observable price method. And if observable price method is not suitable for your product and services, then you go to the acceptable estimation method. In the acceptable estimation method, there are three type of method. One is adjusted market assessment approach. Second is expected cost plus margin approach. And third one is residual approach. We'll be understanding all these methods in detail. Let's first understand the observable price method, which you can say is a preferred method, right? So when entities sell those goods and services separately in similar circumstances and to the similar customer, what amount they charge, right? For example, you have an apartment, you have a building, residential building, in which you have 1 BHK apartment or 2 BHK apartment, right? Normally, 1 BHK apartment you give on a rent for $1,000 and 2 BHK apartment you give on a rent for $1,500, right? If any unit of 1 BHK is vacated, right, and that you want to give to new tenant, so what should be the price, what should be the rent for that 1 BHK unit? My question to you guys.
तो आइडियली जो प्रैक्टिस होती है वो ये होती है कि अगर लास्ट टेनेंट को मैंने फॉर एग्जांपल 28,000 पे रेंट पे दिया, एक साल के बाद अगर मेरा नया टेनेंट आ रहा है तो आइडियली 10% अप्रिशिएट करके हम रेंट पे देते हैं,
So
और
what?
उसको
Oh
बेस
no,
लेके.
my example was different. What I'm saying, you have a residential building in which you have 1 BHK apartment. Let's assume you have 10 apartment of 1 BHK and you have 20 apartment of 2 BHK, right? In that building, normally you give $1,000 for 1 BHK rental and $1,500 for 2 BHK rental. Now, one unit is vacant, right? And so, how much price you will quote to the new tenant?
मार्केट में कुछ
1,000
चल रहा है.
$1,000.
$1,000. Why
Yes,
$1,000? Because
because
all
we are
one
all
beach. Mhm.
we have given to the other guys in $1,000 the same set of services, so we'll charge $1,000.
Mhm. So that is called observable price. In nearby, like for example, if you have to give your, let's say you have like extra floor or extra room, and if you want to give it to the rent, so how do you benchmark? Generally, observe the price in your society, right, and in your
Yes,
neighborhood, and understand like how much
yes,
other landlords are charging, and accordingly you give the quotation to any new customer or any new tenant to come to your place, right? That is called observable price. Hmm? Make sense? Simple
yes,
example. So that is
yes,
called observable price when you can easily observe, right? For example, uh, you go to any restaurant, right? And to the respective restaurant, how they identify the value or the price they should be charging. For example, like in North India, if I say, we have, like some vegetarian food chain, whether it's like Haldiram, Om Sweets, Nathus, right? So there are so many similar brand. If you see like their product, services, or taste is almost same, whether it's like Bikaner, right? So how they come up with their pricing? Looking at the price of like similar chains, like for example, if I'm opening up new brand, let's say Harish Bakeries, like in Gurgaon, if I say Harish Bakery, they wants to open up like new store like Om Sweets or Haldiram or Bikaner. So what pricing they should keep? They look at the pricing of Haldiram, Om Sweets, right, Bikaner, and accordingly, like they will be charging the price for their, foods and beverages, right? So that is called observable price. Normally, this is a first preference method. If the for any product and services, observable price are not available, right? For example, you have created something new. Let's assume you have created made in India drones, right? As of now, let's say drones, we all are purchasing either from China or from US or from Israel, right? We are not making any drones in India, right? And let's come, maybe like you have set up a startup and then come up with a new drone manufacturing setup in India, right? How do you identify the price and what you feel would be the right pricing of the drone in India? So you'll see, like the competition price, right? Which is like how much is the pricing of the US company landing in India, or Chinese company, or maybe like Israel companies are landing in India. What are their key product, and what is their features, and how your product and your feature of the drone is different than them, right? For example, they have a camera of, let's say, 21 megapixel, which you can say shoot or look around for a range of, let's say, 2 kilometer or 5 kilometer. But you come up with 4K camera technology, right, which is very much unique and different, right? And same way you add like barcode scanner, and you have added like RFID code, and your drone can be used for inventory management, your drone can be used for security management, and your drone can be used for by the Amazon for transportation of the product, which is very much unique than any other drone which like other supplier are providing. Then you might be adjusting the price for additional features, right? Make sense or not? So that is
Yes.
called adjusted market assessment approach. For example, you are, let's assume, Emirates, this airline Emirates, and in the world there are so many good airlines, whether it's like Qatar, whether it's United, whether it's Lufthansa, right? But why Emirates pricing is always premium? Why generally, if you have seen, the Emirate price are always being higher, and how they
because of
Hmm,
because of the premium services which they provide to their
absolutely
customers.
absolutely true. So how they come up to the pricing? They see, for let's say from Dubai to, let's say, New York flight, right? Dubai to New York flight. Let's assume Lufthansa is charging $1,000, right? United is charging $900, and let's assume Qatar is charging $1,200, but Emirates says will charge $1,800, right? How they come up to this pricing? They come up with the base price of other airlines, adding the premium of the additional services they are providing. Additional benefit, like better leg room, better leg space, more relaxed, you can say, seats, better food, better, you can say, hospitality, better drinks, which they provide, right? Better, ambience within the aircraft they provide, right? Accordingly, they adjust the prices. That called adjusted market assessment approach, where you consider competitor pricing as a base and then you make plus and minus adjustment based on the features they are providing and you are providing. Right? Same way if you see in hotels industry also, right? There are so many five-star hotels, whether it's like Taj, Oberoi, right? And many more five-star hotels. But you see, like everyone is charging different price. Why? So the prices varies on various other thing also, right? One is like customer rating nowadays. That's also very important. Like earlier, it was not very important, but nowadays, if you see in last 5 to 10 years, it has significant impact. How much is the customer rating that individual hotels is getting, despite of the fact they have 5-star category of or 7-star category of hotel. One is. Second is, the hospitality ambience and the varieties of the foods and like other services they are providing in the hotels. Accordingly they charge. And then location also matter, season also matter, right? If like for example, if you go in Goa in December, it's ultra pack season, right? Ultra travel season. In that time, you will see any five-star property you will not get less than $1,000. But if you go during like the rainy season, then it's completely free. So you can get easily in $100 also, right? So there are so many factors. This has come from adjusted market assessment approach. It may be like competitor price, competitor rating, R pricing, R rating, weathers, or maybe season or non-season, right? These all says like these all things from where when you make the adjustment based on market requirement, that is called adjusted market approach. Make sense? The first preferred method is observable price. Second method is adjusted market assessment approach. If these two don't apply, then you will go to the third method called expected cost plus margin. Have you heard about this term? Cost plus margin approach?
Yes, sir.
Yes, sir.
Any idea what is it?
If my cost is like, let's say 100 rupees, I will put some 20% on that and I will quote 120 to the customer.
Yeah, that's very, very good. Very simple example. And like if you see, I know some of you working with EY. How many of you are working with EY or with offshore company in India?
I am.
Right? So if you see like whether it's EY or any offshore company, we bill to the parent company, to the US company or to the Europe company, right? Or to the global company. But how do we bill? We bill based on the cost plus the markup which we have agreed among the respective countries, right? So the costs include my manpower cost, my infrastructure cost, my depreciations, my overhead. That's how, if like some of you might have seen like cost sheet or billing sheet, or maybe like there's so many internal reports also in your organization you have seen. So there are sales price as well as there is some per hour cost, right? That cost is a combination of your labor hour, your overhead, and other stuffs, right? It's come out from the combination of all those things. And then the sales price is basically the markup which you have agreed with your parent company. That is called cost plus margin approach or cost plus markup approach, right? In the IT project, generally it happens because like sometime in IT project we don't know like what would be the outcome and how much time will it take, right? And how long will it take. So in that case of scenario, like most of the time, when it is like new era technology development, new software development, new application development, like when buyer, or you can say your customer, is also not very clear about his or her requirement, right? So in that case of scenario, as an IT industry, we give them cost plus, you can say like 20%, 30%, 40%, whatever is the agreed markup. So that whatever the number of hours your customer would request you to incur on his or her project, you can bill them accordingly. Right, Prashant? Is that the way sometimes happens?
Yes, sir. Where like outcome is uncertain or we don't know the estimation, then we just it is a kind of a T&M.
Yes, right. So in IT project, it happens very, very often. Same like we discussed another example of offshore accounting firm or business process outsourcing firm, right? So that called cost plus markup, where you discuss and agree about the margins on the cost, and that you will charge on each billable hour or each billable product, right? The next one is residual approach. When nothing applies, when there is no observable item, when there is no adjusted market, there is no market to it, and there is no, you don't know like what will be the cost, and you didn't get into any agreement for the markup also, then you will be applying the residual approach. So this approach is used only when no other method works. So there, like total transaction price minus observable standalone selling price of the goods and services is the residual value. For example, like you might have heard about byproducts. Have you heard about byproducts in your school days, college days, in your costing lecture?
Yes, sir.
Yeah.
What is byproduct?
मेन प्रोडक्ट के साथ जो प्रोडक्ट मिलता है एंड विच कैन बी यूज्ड, जैसे
Hmm.
बटर बटर निकल गया, मिल्क बटर मिल्क
Hmm.
या ये सब छाछ निकल गई एंड ऑल दैट, सो
Yeah.
दैट कैन बी यूज्ड एज अ सेपरेट प्रोडक्ट इटसेल्फ, दैट इज अ बाय प्रोडक्ट which
Yeah.
has a resale value as well.
Yeah. Anyone else would like to add any example?
Yeah, like it's like steel, we are
Hmm.
making rotors for car air conditioner in the car manufacturing. And
Hmm.
when this rotor is produced, some sort of something is coming out of that iron to
Hmm.
make it function. So that
Hmm.
scrap is a byproduct of that
Hmm.
that
Hmm.
rotor manufacture.
Yeah. So how to value that? Right, in that case of scenario, for example, if you have like sales price, standalone selling price for the main product, right? Let's assume you are giving main product and byproduct, let's say at $10,000. And your main product standalone selling price is, let's assume, $8,000. So $2,000 will be the residual approach, right? 10,000 minus 8,000, that $2,000 is the price for the residual product, that is called residual approach, right? So these are like methods of identification of standalone selling price of your product and services. First one is observable price, right? That is always be a first preference. Second one is adjusted market assessment approach, right? That's the second preference. Third one is expected cost plus markup. And if nothing applies, then only you go to the residual approach. Make sense? Gurmehar, Prashant,
Yes, sir. Yes.
Yes,
Avneet?
sir. Yes, sir. Yes, sir.
Okay, so now we are jumping into the next topic, that is called allocation of discount. So allocation of discount is always be specific to the product discount. First need to be allocated to the specific product standalone selling price. Then whatever is the overall or general discount, it should be allocated based on the individual goods and services standalone selling price basis. So if we go back to this example, let's assume the total price you have how much? $115,000, right? And you are recovering how much? $93,000. So what is your discount total? This minus 93, you are giving $22,000 discount, right? Yes, no?
Yes, sir.
Hmm?
Yes, sir.
So let's assume if somebody do not buy extended warranty or insurance, and somebody buy only the car, right? And normally when somebody buy only the car, you give $12,000 discount to them, right? If somebody buy extended warranty, you give 10% discount, $1,000. If somebody buy insurance, you give no discount, right? So first is specific discount. First is specific discount that you need to reduce. So specific discount is not part of your bundle discount, right? So this is your standalone selling price, SSP, right? This will be your standalone selling price. So now, what is your remaining discount? What is your remaining discount? 22,000 minus 13,000. How much is it? $9,000, right? So this $9,000 you need to allocate at this ratio. Multiply by 9,000 divided by this. Mm. One second. 1 second. I am just trying to put the formula, but yeah, there you go. Right? So this is the discount which you will be allocating to the respective. Have you understood the math? How I calculated the discount?
Yes.
Yes, sir.
Allocated journal discount, or you can say deal discount. So allocation of deal discount, this $9,000 you have allocated in this manner. Then what will be the sales price of the individual item? This will be 88,000 minus this. Right? This is what 93,000 we agreed. Make sense, everyone?
Yes, sir.
Yes, sir.
Right? So this is the allocated transaction price for individual item. That's how you'll be calculating. That's what is step 4 is all about. Step 4 is all about allocation of transaction price to the respective performance obligation. So how you will be allocating? First, identification of standalone selling price. How do you identify the standalone selling price? After removing the specific discount on the fixed price, right? The discount which is being pertaining to the specific item need to be reduced first, and then remaining discount you need to allocate to reach to the final amount. So this is your allocated transaction price to the performance obligation. Now let's look at this theory. Allocation of discount. Specific discount should be first allocated to specific product, right? Then overall or general discount should be allocated based on individual goods and services. Then allocate the variable consideration if there is any. Allocate the variable consideration to the specific performance obligation if variable consideration relates to the specific performance obligation. Same manner, if variable consideration is not related to the performance obligation or distinct goods or service, then allocate the variable consideration based on standalone selling price. So this is all about step 4.
तो इसमें
Allocation
थ्योरी
of
अगर सिर्फ थ्योरी पढ़े हैं
hmm,
so बंदा मतलब थोड़ा घूम सकता है अगर इसमें बीच में टेबल भी दे दो ना नीचे विद अ डिस्क विद एन एग्जांपल
hmm,
द नोट्स तो अगर मे बी इफ वी रिवाइज इट आफ्टर अ मंथ और सो तो
hmm,
रिकॉल आराम से कर सकते हैं वो टेबल बहुत हेल्पफुल था द एक्सेल शीट
ठीक है, got it. So no worries, we can add it here. Okay, so I'll adjust and send it to you again, this updated one.
ओके सर थैंक यू
right? So this is it for today's class. Right? Any doubt or anything you guys need more clarification on allocation of transaction price? So we have covered step 2, 3, and 4. So tomorrow we'll be covering step 5 and the remaining small topics. Right?
Okay, sir.
Okay.
Bye.
Cool. Okay. Enjoy
Okay,
rest of
thank
your
you.
Saturday. I have sent already the notes. Please go through that, right, before coming to the class tomorrow. And tomorrow we'll be doing some practice also from the software.
Okay.